premium finance. What is it? When does it make sense? When does it not make sense?
We've kind of been around the industry a good bit, and we've seen majority of advisors and insurance agents can't even explain how these work.
We think this is one of the worst financial decisions you could ever make.
On paper, in theory, yes, that could work, but there's all of these just like hidden risks involved with this that we're going to unpack.
So the insurance company doesn't care if you're personally paying the money or a bank's paying the money. The agent isn't going to get a huge commission regardless. The person recommending this should not be allowed to practice as a financial advisor, let alone an insurance agent, because this could harm the client. If you look at the fine print of the policy, nothing's guaranteed. The insurance company has control of what mortality and expense charges they pay. Those aren't disclosed.
I have 5 tips if you are going to consider this, how to do this correctly.
There are certain financial strategies that are often pitched to high net worth clients that are positioned as absolute no-brainers. Premium finance life insurance using Index Universal Life is pitched to high net worth clients all the time as a no downside, huge upside. We're here to debunk this. We think this is one of the worst financial decisions you could ever make. And these are, relatively new, and just based upon the math alone, we'll show you in today's episode why you should avoid this at all cost. If you're in one, options to get out of it. So, Jamison, let's get right after it. So give us an overview. There's 2 conversations here. So I don't think either strategy by itself is evil. Premium finance, on a high level can make sense for certain people. So first, let's talk about what it is, when it makes sense, when it makes 0 sense. And then let's talk about Index Universal Life. Index Universal Life is not evil by itself. Heavily sold, 0 down. You participate in the S&P 500. But I'm going to talk about that. If you underlook the hood of these things, why, even a boring traditional whole life policy with the right company will crush these things over the long term. But you could still do an IUL that works as long as you assume around a 5 to 5.5% return assumption. But combining that with the premium finance is just literally, you have all these levers. One goes wrong and the thing implodes. So let's first break it down. Premium finance. What is it? When does it make sense? When does it not make sense?
Yeah, these are like, so if we were to publish like the IRS publishes the dirty dozen list. If we were to have our own dirty dozen financial tools, this would probably be on the list. It's just like premium financing. And again, there's good premium financing.
Yeah.
It's oversold. But high level, essentially what it is you're going to take a loan, and there's a difference between premium financing and private financing. You take a loan from a bank, so bank structures a note, and you use that loan to pay premiums on insurance. And so it's generally pitched, and these loans are interest-only loans. So like example, you could pay a premium for $500,000. The premium to the insurance could be $500,000 a year that the bank's going to pay, and then you're just paying the interest on that note along the way. So like you said, there's a lot of variables and levers that we can talk about, but just structurally, number one, you have to have assets to back that loan. So it's a lot of times it's pitched as, here's this vehicle to get insurance that doesn't cost you anything out of pocket or cost you, just the interest, which could be $20,000 or $30,000 a year out of pocket. So number one, you have to have, it's just a traditional loan. You have to have assets to back it. There has to be something as collateral. They're just going to write you a loan based on this policy. And it can make sense if you have to have a good exit strategy to pay that loan off. So what I mean by that is, it'll be illustrated and pitched a lot as like you could do nothing and never pay it back. And then when you die, that death benefit pays off what's left in the note, and then your family gets the difference. So like on paper, in theory, yes, that could work, but there's all of these just like hidden risks involved with this that we're going to unpack. And I would say, let's talk about who this is pitched to and then who it is for and who it's not for. It's generally pitched to people that they want insurance, but it's usually a lot of business owners. They don't want to take the cash and park it into insurance. They want to take that cash and put it somewhere else that's going to get a higher
In their
return.
business, so
Their business, yeah. If the business is
Yep.
producing, 20% return per year, they're like, well, why would I take this $500,000 and put it into insurance? Well, let's take it from the bank and do that, redeploy the cash elsewhere. The only way this makes sense, in my opinion, is if you have like no liquidity event is guaranteed, but if you have some sort of liquidity event that you can use to pay that note off, because it gets illustrated, number one, like I said, the death benefit pays it off, or number two, you take some of the cash value out and then pay that loan off, and then the rest gets used to keep growing the policy.
These are really pitched heavily because insurance agents will earn a commission generally between 50 to 100% of the payment going in the life insurance policy. So the insurance company doesn't care if you're personally paying the money or a bank's paying the money. The agent is going to get a huge commission regardless. So we have an example right here of a client getting pitched. It's basically pitching, okay, put in $425,000 a year into this policy for 10 years. So right off the bat, this agent would earn $200,000 to $400,000 commission right off the bat. And so obviously there's like, he's pitching this as like, this is the greatest thing ever. Selling the client, you just have to pay the interest. And so some of these you can pay the interest and then pay double the next year because as the loan grows. But this one's pitching like, let the loan just compound. So like literally 20 years into this thing, the loan balance here is going to be $8 million. And so anything goes wrong, this client's on the hook for $8 million. Hypothetically, they get his kids a death benefit, which may not even be there if the policy doesn't perform. So also this agent can earn a $200,000 to $400,000 commission. However, he's telling the client, you have to pay $30,000 a year for the next 10 years, and then this thing's all going to work out. There's a couple issues with this. First of all, no bank offers this on a fixed rate. So the interest rate is variable.
SOFR plus, actually I have it right here. It's usually SOFR plus, 150 to 300 basis.
Yeah, so if you look at this thing and the interest rates can fluctuate dramatically, this is assuming 5.7. This agent actually assumes the interest rate long-term goes down to 4.5. It may happen, it may not. But that's just like that alone.
You don't want to be in the ball game on relying on
predicting
interest rates.
The person recommending this should not be allowed to practice as a financial advisor, let alone an insurance agent, because this could harm the client millions.
Well, let's talk about the structure of this guy's balance sheet too. He needs a death benefit,
which you can go get in a term policy and pay a couple $100 a month for. Because it's, he's highly levered in.
He's very high net worth, all in real estate in his business.
Yes.
And so why would he add more leverage, more of a loan onto his balance sheet that is already not liquid enough and, you could argue over leveraged?
So real quick, simple is like, hey, dude, you put in $30,000 a year for 10 years and your kids are each going to get like, $3 or $4 million in the end. If 10 different things work out, interest rates drop, the policy performs. So first of all, we have no idea if interest rates are a bank. The bank could have a margin call along the way. So the $30,000 a year is just crazy for 10 years. Now, the other aspect of this is he's pitching an index universal life policy.
Now, let's unpack that margin thing real quick because that's important. Again, you have to have collateral to give the bank. I'm not a banker. We could look this up. It's some percentage of, I don't know, something. You're going to have a few $100,000 to give as collateral. What do people who normally use as collateral? Probably a brokerage account. And so what determines the growth or the value of the brokerage account? Stocks. So if stocks go down, interest rates go up, which could happen in any type of, severe economic situation, you don't have enough. So the loan balance is going up. The cost of the loan is going up because now the interest rate, which is a bit variable, is going up. So for you to service the loan, now instead of paying 30, maybe you're paying 60 a year. Your loan balance is snowballing and your asset that it's backing is going down. So that's just like a nightmare scenario. Bank's going to do a margin call and the bank doesn't care, but the bank wants their money to support that loan because it's a bad deal on their end. So many things can go wrong. And then the next issue is the underlying type of insurance, which is very important as well.
Yeah, so if we unpack how index universal life policy works, so index universal life policy is usually tied to an index. Like let's just pick S&P 500. So with this company in particular, you have a couple of different options. You can pick a floor of 1, a ceiling of 9.25, a floor of 0, a ceiling of 10.25. However, if you look at the fine print of the policy, nothing's guaranteed. The insurance company has control of what mortality and expense charges they pay. There's like minimum, maximum charges. Those aren't disclosed. Those go up 1% a year. The whole thing can implode. But the returns themselves, this agent is pitching a 6% return on an index universal life policy, assuming it's S&P 500. If you look up the S&P 500, returns since the Great Depression, 1926 till now, were over 10% a year. Goes to 11% if you reinvest dividends. You look at this contract, there's two things that have happened. One, you don't get dividends. Dividends are usually are historically about 30% of the return. So now we're at 7. If you look at, the market last year, the S&P 500 did about 18%. If you're in this policy and we did the 0 to 10.25, you would have been capped at 10.25. You would have missed on 8% of your returns. A lot of years the market's doing 20, 25. You're only getting half of that. So if you look at an analysis in this structure where you're getting 0 to 10.25 without dividends and with it being capped. Now, the good news is you're missing the bad years. The bad news is you're missing a lot of the good part of the good years. Your net return is going to be somewhere between 5 to 5.5%, depending on what your floor rate is, and if you look at the expenses of the policy that erode that, you're really looking at potentially 3 to 4%. So him showing a 6% return based upon the last 100 years is impossible. I mean, it just would not occur.
And
it has never occurred. Now, why does the insurance industry allow you to illustrate something that's not possible? Why is the insurance company not investing in the S&P 500 when it's backed up? They're investing in derivatives. It's a highly complicated thing. They're guaranteed to make money in this. And if anything goes wrong, you're stuck with this loan bill. You're stuck with a policy
shifting
that's
the
imploding.
risk onto the
100%.
client instead of
There's
the
no
company.
guarantees here. So the whole thing, both sides in this scenario, I wouldn't do either. In this client situation, we wouldn't do a premium finance, and we would never do an index universal life illustrating 6%. Now, where this could make sense on a premium finance is if you have a business owner that's going to sell their business in 5 or 10 years. They're young. Let's say a business is worth $50 million. They have a big estate tax problem. So, 30 million of that between the husband and wife would be tax exempt if they die right now, but 20 million would not. So it'd be 40% of that would be a tax bill of $8 million. Okay. Maybe a client's 50 years old. They're going to sell their business in the next 5 years. They need $8 million death benefit. All their cash flow is going in to get reinvested in the business to get ready for the sale. Well, premium finance, they're young, they're healthy, could make sense. Fund the premiums, use a traditional whole life. Maybe the interest on the loan is 1% higher than the return of the whole life policy. But after the business is sold, there's a couple $1 million loan balance. Out of the 50 million net of taxes, maybe you get 35 because part of it, the S corp part of it's capital gains. You pay off $2 or $3 million of the loan. But now you have that tax liability permanently taken care of for the rest of your life. But this is basically suggesting that premium finance, just do it for 10 years and let the assumptions ride for the next 50 years.
Yeah, the illustration was not paying the loan back. It was
Ever.
I mean, this guy's
Yeah.
he's in his early 40s.
Yeah.
And it's like you're gonna
40 or 50 years of what ifs. Yeah. Of assumptions that aren't probably will implode or are guaranteed to implode under these
Yeah.
illustrations. Now, so that would be where premium finance would make sense. But we wouldn't recommend using an index universal life policy because the index universal life policies in general look really good. They're easy to sell. It's like, oh, you get the market return 0.4. When you unpack the contract, they're horrible. And a whole life policy with the right company is going to crush the performance long term with zero risk. All the risk is on the insurance company, not the individual. So that's where a premium finance company structure could make sense. If maybe the policy can pay back the loan, but you should also be able to pay back the loan on your balance sheet. If you cannot, you should steer clear of this thing. No question. There's no discussion here. This is a black or white conversation here.
I have five tips on if you are going to consider this, how to do this correctly. Number 1, use the right type of policy. Don't use an IUL, use a whole life. Number 2, use conservative return assumptions. So exactly what you just said. Number 3, have a clear exit strategy. So I have a way to pay it off. 4, have proper collateral planning. Again, you need to have something that's going to be able to support that loan. And number 5, make sure your team of advisors are aligned, because exactly how you started this conversation, you'll have an insurance agent trying to get a commission. Hopefully you have someone that knows what they're doing on your team that can then say this is a bad idea, but you need to make sure, your tax person, your estate planner, your advisor, everybody understands this and knows what they're doing.
Yeah. And if you have one of these already, a premium finance using IUL, we genuinely feel, bad, but let's talk about how to unwind it before it gets, because every year you keep it, it's a compounding problem in the wrong direction. And it just gives me an issue. These IULs aren't going to keep up. If you separate from a premium finance, if you want an IUL policy, not the worst thing in the world. Because some of the companies that don't offer guarantees, they'll accept you with health problems more than a whole life. A company with a whole life would accept you. So sometimes it's the only option on the table. So if you're gonna get an IUL, not a bad thing by itself. Don't premium finance it. Make sure you can pay for it out of pocket. Use a 5% return assumption max, and make sure that death benefit's gonna last till 110, 120, assuming a 5% return. Then it's okay by itself. But I would use it if you're having trouble getting accepted other places in a more guarantee. Life insurance is where you want to have guarantee. That's not where you want to take your risk. And you don't mix the two, in our opinion. But that could be a whole podcast episode itself. So high level, it's a strategy by itself, can make sense for very few people. We're talking out of the 1%ers, people that are going to sell their business. And
I've
have the
seen
liquidity.
one scenario where it could make sense. And
Out of this year, out of how many cases?
I mean, I'm just saying,
on?
I've been doing this for 7 years, 8 years now. Like, one time I've seen that it could make sense. Yeah.
Yeah. If you have a real high cash, one high bet, just why take the risk of a loan? Just fund the life insurance, out of cash flow.
Yeah.
This would really be in that sniper shot scenario where you're don't have the liquidity, need a bunch of life insurance, if you have estate tax problems, so get it, sell the business, pay the loan off there. And again, you do have the option of letting the life insurance, but with the way life insurance policies are net of fees performing compared to what loan rates are, the spread is working against you right now.
I would say just like the meta lesson here too is like,
If it seems too good to be true, it is.
yeah, well, yeah, that I was just to say, like, complication and complexity is not the answer. If you probably already have a complex balance sheet, don't make it more complex, and like, don't invest in something that you don't understand or can't understand. And we've kind of been around the industry a good bit, and we've seen majority of advisors and insurance agents can't even explain how these work in detail, and they're trying to sell them to you. So if the person selling it can't explain it correctly, you can't understand it, you should never buy it or invest in it.
Well, if you have any questions, if you've been pitched one and you want an alternative, or if you need to unwind one, or if you're in that, one of 100 scenarios where you think this makes sense, we're happy to answer any questions you have. Thanks for tuning in. We'll catch you next week.